Good day, all. Ira Epstein of Linn and Associates with your metals market update, and this is for Thursday, and this is the last trading day of February the 28th, 2019, about 3:15 p.m. Central Standard Time. Stock markets are just closing, and as you can see, we're going to have a lower day. We're lower in the copper market, the silver, the gold markets. For those of you that 2 weeks ago were into my live webinar, we did a mini gold report in there, and I kept showing you the seasonals around that February 24th time frame. Classic as to what the market's done in the pullback. It's interesting to also watch what's going on in the euro and the dollar. Trading ranges have narrowed in. In fact, what I'm hearing, because I was listening today to the hosts on Bloomberg, as they're talking as to how little volatility we're seeing in the markets. I got to tell you, big volatility like you had in December has a way within it afterwards of creating no volatility for a while because you've basically worn everybody out. That's what I think. I've only done this 5 decades, so I think I know what I'm talking about a bit there. But when you look at the gold market, you can see how it's come up from that 1180, stalled out here. Certainly nothing bearish looking on the chart. We're in a correction phase. That's how you'd look at it on the weekly chart. Why do I say that? Because you're still over the 18-week average of closes. Now, this last break low, and we're not through with the week yet, this is a weekly chart, was 13.70. As you can see right now, we're right around that price. So the markets will watch that tomorrow to see if you break through a previous break low, and that could take out some of the friendliness of that market. When I come to a daily bar chart, you see how you had the spike up, right back down. For those of you that watch our price counts, and we do price counts with our other piece of software that we have, our Linn, our QT Market Center. And what happens with that is you hit certain levels like you would think on a Fibonacci count, but this is a mixture of swing lines and proprietary math formulas that we have. It got right up there, and with the seasonal, it seems to have run out of some momentum. You're in a downtrend according to the pattern of lower highs and lower lows. To negate that pattern, you have to take out 1335.80. The market fought yesterday at the 18-day average, closed under it, and today you fought again at that 18-day average and still closed under it. One number the market might look at is the 100-day average, although it's rather far away at 1270. Closer is the lower Bollinger Band, which is down at the 1302 level. In terms of momentum, it's down. So we have a downtrend. We have the market with downside bias since it's under the 18-day average. That's how I determine bias. The resistance is back at the 18-day average of closes. If the market wanted to extend the decline, about $12 lower some of the support. When we come to the ETF GLD, we today closed under that 18-day average. So you have the lower highs, lower lows. That's bearish. Bias down since you closed under it, and again, momentum down. Battleground, the 18-day average. If you had a big slippage for any reason, maybe you get to that lower band initially, 122.65. When I come to the gold miners, the ETF of them, GDX, lower highs, lower lows, third day in a row of staying under that 18-day average of closes. The last break low was right in this area, so we're in a zone where maybe the market tries to get its legs under it. The market is not yet oversold. It could become tomorrow if there's any further decline. In the gold-silver ratio, and I've gone April gold versus May silver, you're still climbing away where silver is losing to gold. That is typically not what makes a bull market. And with that, you can see silver, lower highs, lower lows, honing in now on the lower Bollinger Band at 1557. From where the market was, that's about a 60-70 cent drop in the market if it gets there. And when I look at the momentum, you're already in oversold territory. So yes, you can go lower, but I'll be surprised if you don't find some, let's call it short covering against that lower Bollinger Band. In the copper market, you still have the embedded reading. Embedded means both numbers in the slow stochastic get over 80 and stay that way. Until that is lost, I contend that momentum leads price, and on pullbacks, the pros are probably buying. Now, if you take out this last break low of 293.45, you will turn the pattern to one of lower highs, lower lows. If you lose the embedded reading and the red line closes under 80, it could mean that price and the 18-day average want to come together. Therefore, the onus is on the bull to keep the market together, ideally not letting it get under that price and certainly not letting momentum turn down. The platinum market did a runaway to the upside. I mean, this market just picked up and it said enough with the palladium market running on us, and away it ran. And certainly this versus the gold market has had a pretty good trade. In the palladium market, you haven't given up your bullishness. The market up today, $21 again, still acting with the higher lows, higher highs, still has the embedded reading. Lose the embedded reading and you might get the first reasonable correction in this market. And you haven't had one since all the way back here in January. So it just gives you an idea how strong this market has been. In terms of the dollar index, God darn it, just like I write in my charting course, this is classic. Downtrend challenged the 100-day average. You're getting into oversold territory. If you can spin further down, I would expect that we get support wherever that Bollinger Band comes in. You reach down last night, you go to that band, get through it by 3 cents, and my gosh, you pop up way up here. Nice little rally off of that. I had guys coming in the office because I was talking about this. Now they're all saying, what is the trend? Well, you're oversold, but the dollar's entered a down phase. You'd have to get up through these highs to prove to me different than that. And this could be where some of the commodity companies that we're talking, especially the Goldmans and so on, at the end of 2018, where they thought the dollar might be entering a more bearish phase, this could be a sign of that. This was certainly the first good break. It stopped where it should have. It can bounce here, but now the question is, what next? You know, part of what you do on markets that get quiet, you know, that's why I was cracking up. I'm sitting at my desk today and I'm hearing everybody talking. This isn't the way it was in December, and I'm talking to TV announcers. You don't always want that, but when you get what you got, when you don't get the real craziness, these pivot points are a neat way to look at a market. Now, I keep saying I have 2 videos. We did 3 videos. I did one video that explains how the formula works, so you get to understand what it does. Then I did a video that just explains together how you put this, how you plot it on your chart, and what you do. And then my third video, I decided to tie momentum with the pivot point, my slow stochastics, to give you a short course. And yeah, folks, it's totally free. If you haven't seen it, take a look at it. It's another trading tool. How do you get it? Give us a call. You can go to our website and sign up for it. It's in our carousel of free offers, or click right up here. I'm Ira Epstein. You have a good day, and I'll see you all tomorrow.